Hello there. Welcome back to Cost and Management Accounting and 6. Still working on a question paper of June 2022. This question paper that we have for today again. And on this question paper, we want to look at question 2 on that question paper that is on standard costing. So this question that we have, we're going to read through the question and answer the questions that are going to follow in terms of the calculation that we are having in this question. The question reads down and stands provided you with the following information concerning their business for the year ending 30 November 2019. The following standard information, we have got 6.5 kg material, it's 15 rand per kg per unit. 2 hours labor, it's 6 rand 50 per hour per unit. And then on budgeted information, we've got fixed overheads, 35,050 rands, and variable overheads, 20,200 rands, budgeted hours, 450. So this is what we have. And then also we have got actual information that we are given there. It reads 350 kg material was purchased of 5,500 rands and 1,200 kg material was used to produce 250 units, 650 hours labor at 8 rand 50 per hour. And then we've got fixed overheads at 36,350 rand. Then lastly there we have got variable overheads, which is 25,300 rands. And this is the information that we have on this page, and then we can go to the next page to see what we have. Then we come to the required parts, calculate the following variances and indicate whether each variance is favorable or unfavorable. So very important to take note that we have to indicate if the variance is favorable and unfavorable. So we are going to start with the first one, which is material price variance. So we are going to go there. So what is important on this on standard costing is to master the formulas to calculate these variances, and to see that the first that we want to calculate there, if you check on the first part, which is 2.1, we've got material price variance. So we want to put down the formula first and then calculate the value that we have there. So we've got 2.1 and the same material. We've got material price variance. So what the formula that we use for material price variance is that we say standard price is SP minus actual price in brackets, and then we multiply by the actual quantity. Then we multiply by the actual quantity. So this is what we have, guys, in terms of this formula. So what is important now is to go and identify which is standard price, which is actual price, and then actual quantity. So from the information that we are given, you can see that standard information is given at the beginning there. So you can see that we are told that 6.5 kg material, it's 15 rand per kg per unit. So remember, this is material. So we are here with material, and we are given 15 rand. So this 15 rand becomes our standard price. So we're just substituting there, and we've got 15 there, and then we subtract our actual price. So the actual price, obviously, we're going to get it at the end there where we put actual information. So we come here, the material that we have there, it's 350. We have got 350 kg material was purchased at 5,500. So to calculate now the actual, we have to say our 5,500, which is the total value divided by, we divide by 350 to get the actual price. So what we are saying 5,500, then we divide by 350. Then obviously there, let's try to calculate that one. You are going to get 15.7, 15.7, 142 as such. So we have to round it up to 2 decimal places there. We have 4 there, so it doesn't change 1. So our answer is 15.71. So this is what we have in terms of our actual price. So this is what we have there. So we can just go there and put that one, which is 15.71. So we are there. There we are saying 15 minus 15.71. 15 minus 15.71. And then we multiply by the actual quantity. So for the actual quantity, again, we go and check what we have in terms of actual quantity, but already we know that actual quantity is 350. 350 kg becomes our actual quantity. So we just put our 350 there. So here we are saying 350. So by calculating this now, 15 minus 15.71, then we multiply by 350, the answer that we're supposed to get there, obviously, by saying 15 minus 15.71, you're going to get 0.71. Then you multiply by 350, and obviously, there you calculate to get the correct figure, you get 248.50. 248.50 of which this is in rands. And we are seeing that, and remember the question, the emphasis of the question, we can go back to the question and check in terms of what the question is saying. The question said indicate whether each variance is favorable or unfavorable. So with the answer that we have got there, so to identify if it's favorable or unfavorable, you have to check in terms of which one is greater in terms of standard price and actual price. So in this sense, we have our standard price. We have got our standard price being less than actual price. So we have got standard price less than our actual price. So when we have such a scenario, it means we are having an unfavorable position. So this one is unfavorable. So this is what we have. So the opposite is true there. If our standard, if we now have a scenario whereby standard is now greater than actual price, so it becomes favorable. So this is what we have there on the first part. Then we go and check on the next question. So the next question now requires us to calculate the material quantity variance. Material quantity variance, which is 2.2. Material quantity variance. So we can come here. We are now on 2.2. 2.2. We are saying material price variance. So the issue is how do we calculate this material price variance? Remember, we have to put down the formula first of material price variance. So on the material price variance, we are saying it's standard quantity minus actual quantity. Then in brackets, then we multiply by standard price. Then we multiply by standard price. So our task here now is to identify which one is standard quantity, actual quantity, then standard price. But so we've got information that we are given there. We go to actual to identify which one is the standard quantity first. Our standard quantity. Right. We come here, check the standard quantity. Here we've got actual. So standard we are given there at the beginning. Remember, we are told that here we have. Let's check there which one do we use there. But we are told that we have got 6.5 kg of material per unit. That is per unit. So so we need to know how many units were there, and then we multiply by 6.5, which is the standard, to get the standard quantity. So we go down again to check how many units do we have there. We have got, if you come here, we've got 1,200 kg material was used to produce 250 units. So we have got 250 units that we have there. So that's 6.5 multiplied by 250 to get the actual quantity. So we are now saying for actual quantity, we are saying 6.5. 6.5 times our 250. Our 250 there. And then this is standard quantity. Then actual quantity, we are given it there. We are seeing that for actual quantity, we are given that we've got 1,200 kg material was used. So this is actual quantity. So minus 1,200 there. Then the difference there, we can put a, then the difference now we multiply by the standard price. We multiply by the standard price, and we know that the standard price we are given it here is 15 rand. So we multiply by 15. So this is what we have. So let's try to break down as we calculate it, 6.5 times 250, you're going to get 1,725, 1,625, and then you subtract 1,200. Then you multiply by 15. So what you get there? What you get there? Of course, when you say 1,725 and 1,200, you are going to get 425. You multiply by 15. So we do that. 425 times 15, we get 6,375. Right. So remember, we have to identify. We have to identify whether this is favorable or unfavorable. So for us to identify whether we have put in a favorable and favorable or unfavorable, we have to analyze in terms of standard quantity and actual quantity there. So you see that in this case, we have our standard quantity being 1,725. Standard quantity is greater than our actual quantity, because 1,625 as compared to 1,200 standard quantity is greater. So in that case, it means we have got a favorable. So the opposite is true. When the standard quantity is less than actual quantity, it means we have got an unfavorable position. As simple as that. So this is what we have. This is what we have in terms of 2.2. Then we can check what we have in terms of the next question. Next question is labor rate variance. We are here. Labor rate variance. This is now 2.3. 2.3 now we can say labor rate variance. So let's try to see what we have there. We have 2.3. So we are saying labor rate variance. So we put our formula first in terms of labor rate variance. When labor rate variance, we are saying standard rate minus actual rate. Then we multiply by actual time. Then we multiply by actual time. So for the standard rate, we get it there at the beginning. The standard rate you get it at the beginning. So if you come here, you'd see that we are told here that 2 hours labor, it's 6.50 per hour. So this 6.50 becomes our standard rate. So we've got 6.50 there. There we've got 6.50. Then we subtract our actual rates. Obviously, our actual rate, we're going to find it there with actual information. Our actual rate, let's try to see what we have. We are told that 650 hours labor at 850. So 850 becomes our actual rate. So you know we've got 850 there. Then we multiply by the actual time. Then we multiply by the actual time. So actual time, obviously, section of actual information, we are given that 650 hours. So this becomes our actual time, 650. So we are saying times 650. And what we get there, obviously, 6.50 minus 8.50. We are going to get 2 there. Then we multiply by 650. And we are going to get what? 1,300. When we analyze in terms of our standard rate and actual rate, we are seeing that our standard rate is less than standard rate. We are saying our standard rate there is less than our actual rate. So in that scenario, if we have that scenario, it means we have got an unfavorable position. So here I will just summarize that it's what is unfavorable. So what does it mean? The opposite is true when our standard time is greater than our actual, our standard rate. Sorry, this is rate here. Our standard rate is greater than our actual rate, so it becomes our favorable. So this is what we have. So we go to the next question and check what we have. So in the next question now, we are now on labor efficiency variance. So we go back again to see how can we calculate labor efficiency. For 2.4, we are now on labor efficiency variance. This is our labor efficiency variance. So the formula that we are going to use there for our labor efficiency variance, we are going to say standard time. Then we subtract our actual time. And then we multiply by the standard rate. We multiply by the standard rate. So this is what we have there. So for standard time, we are going, remember standard information we're given at the beginning there. We are being told that we have got 2 hours per unit. 2 hours per unit are very important. 2 hours, and this is per unit. 2 hours per unit. So what then we know that the number of units that were there, we get them on the actual section. We've got 250 units there. So it means we're going to say 250 times 2 hours to get the standard time. So 250 times 2 to get the standard time. So we're saying 250 times 2. Then you get the standard time. And then there we try to see what we do there. Then we subtract the actual time. So the actual time, let's try to check it there. Actual time, let's try to check it on actual information that we have there. Actual time, we have got 650 hours labor. So this one is actual time 650. So we're saying minus 650. So all this we now multiply by the standard rate. We now multiply by the standard rate. So the standard rate, we get it there in the beginning. In the beginning, where we put the standard information, it's here 6 rand 50. As simple as that. So we multiply now by 6.50. So this is what we have. Then we calculate. We calculate there. Let's try to calculate using our calculators. 250 times 2. 250 times 2, what do we get? Yes, we get 500. So we put 500 here. Then we subtract 650. Then the answer that you're going to get there, you multiply by 6 rand, 650. So here, obviously, we're going to get 50 here. Then our 50, we are going to get 150. It's 150. And then we multiply by our 650. When you do that, we are going to get 975. 975. So this is what we have. We get 975. And then we have to determine, remember, to determine whether it's favorable or unfavorable. So in this instance, we are checking here. 500 compared to 650. So we are seeing that standard time is less than actual time. We have standard time being less than actual time. So in that instance, it means we are going to have an unfavorable position. So here we've got unfavorable. So the opposite is true when we have our standard time being greater than our actual time. So it means we are going to have a favorable. So this is what we have in terms of 2.4. 2.4. Now we go to 2.5. Let's check what we have on 2.5. 2.5 requires us to calculate the fixed manufacturing overhead expenses. Fixed manufacturing overhead expenses. Let's try to see how do we calculate it. What we have in terms of fixed manufacturing overhead. So the formula we are going to say it is equal to budgeted fixed overheads minus actual fixed overheads. So we're going to come here and see that we've got our budgeted fixed overheads. We are having the information of budgeted information here. So this is our budgeted fixed overheads, 35,050. And then we subtract our actual fixed overheads. Actual fixed overheads. Let's try to see what we have there in terms of actual fixed overheads. Let's try to see there. We are given it here. Here 36,350. We're having 36,000 there, 350. So come here. We're saying 36,350, as simple as that. Then I'll calculate the difference between the two. We've got 1,300. we've got 1,300, and we are seeing that our budgeted fixed overheads 35 is less than our actual fixed overheads. Then when we have such a scenario, it means we are having an unfavorable position. So here, unfavorable. What does it mean? It means the opposite is true. We are now saying budgeted fixed overheads when it's greater than actual fixed overheads. Now, in that sense, we have a favorable. So this is what we have in terms of 2.5. Then we go to the last one, which is 2.6. Let's check what we have on 2.6 there. Let's check what we have on 2.6. 2.6. 2.6, we are here. 2.6 says fixed manufacturing overhead volume. Fixed manufacturing overhead volume. So this is the last one, fixed manufacturing overhead volume. So let's try to see that one. Fixed manufacturing overheads, the formula that we have there is standard time minus our budgeted time, and then we multiply the answer that we get there, we multiply by standard rate. So this is what we have. So our standard time, let's check what we have in terms of our standard time. We have got, remember, on standard information, we are told that 2 hours per unit. We are told that we have got 2 hours per unit. So remember, the number of units that we have there are 250. So it means standard time now is 250 times 2, and then we get our 500. So this is our 500 representing our standard time. So here we have got 500. Then we subtract the budgeted time. We subtract the budgeted time. So we come on the section of budgeted information there. And we are seeing that we've got budgeted hours, we've got 450. So this becomes our budgeted time. Then standard rate now, our standard rate, we are using the budgeted information to find our standard rate. We've got budgeted overheads of 35,050, budgeted overheads of 35,050, and we have got budgeted budgeted hours of 450. So to get the budgeted rate, now we are saying 35,050 divided by 450. Let's try to divide that one and see what do we get there. Let's try to divide that one to see what actually do we get there. We are going to get, let's just try to verify that one, 35,050. And then we divide by 450. We get 77.888. 77 here. 0.8888 carrying. So we need to reduce to 2 decimal places. So basically what we are going to do there, we go to round this one. There we've got 8, we'll change 8 to 9 here. So it becomes 77.89. So this is what we have. So you are now saying times 77.89 there. And obviously there you subtract the 2, you get what? 50 here. Then you multiply by 77.89. So this is what we have there. So we can now multiply those 2 to get the variance. So what are we saying? We are saying 50 times 77.89. We are going to get 3,894.5. 3,000. So it means here we have got our 3,894.5. This 0.50. So this is what we have in terms of the variance. And remember, our question, like always, requires us to identify whether we've got a favorable or unfavorable. So here, if you look at here, standard time and budget time, you are seeing that we are having a scenario whereby our standard time our standard time is greater than our budgeted time. So here we've got a unfavorable. So the opposite is true. Standard time less than budgeted time. We've got a favorable. So this marks the last question, and this is the end of the question. Thank you for listening, guys. Let's stay tuned for more videos. Those who will subscribe, please subscribe and share. We are still coming with more videos as we prepare for exams. As for today, I'm signing out.